Hello, good day everyone. In this next class lesson, we are going to be discussing about it's a kind of question and answering, and I'm going to be picking this topic of what we discuss in our private in our Telegram discussion group. We were discussing how to identify high probability trade setup in choppy markets and all that. So I sent a chat. I sent a chat on V50. I was like kind of asking everyone about what they see and what are the narrative they can see, whether they are also following everything that has been taught to them in our previous class section. So in our last class section, I taught and talked about order blocks, finding high probability order blocks, and I said order blocks are everywhere and you can see them on your charts, and also they tend to be stronger on a higher time frame, and we use more of the higher time frame order blocks narrative to find or to blend our bias. So I'm going to be touching briefly on the examples of that chart that everyone was talking about, which is the V50 chart, which is in front of you here. So I would like to just do a few corrections and also show some things that you guys are not seeing or taking note of when you are looking at your chart. So how do we start? Okay, let's just start this way. So now, what do you want to be doing when you want to anticipate you want to anticipate a high probability trade setup? Now, number one, we need to establish from a higher time frame whether we are bearish or bullish in order flow. You need to be establishing from the highest time frame. What are the higher time frames? The higher time frame are your daily, weekly, monthly. Lower time frame will be ranging from 12 hours. Mine is 12 hours, but yours will be 4 hours. Anything below the daily time frame down to 1 hour is your lower time frame. So from the 1 hour down to 1 minute is your intraday lower time frame. So that is the way I delineate it, just for me to know that that's how I've been using these things. Sometimes they call these lower time frame. Sometimes we can call it medium time frame, but just not to just give a convey, I just like to just make it simple and plain. So your higher time frame is your daily, anything from the daily down to 1 minute stretch, they are all lower time frame, but the lower time frames have iron keys. So this from the daily to the 1 hour, for anything down from daily to 1 hour is your lower time frame. These are your lower time frames. Now from the 1 hour down to 1 minute, that is your intraday lower time frame. I hope that one is clear. So let's continue. So you have to establish the direction of your order flow. What's the order flow saying on the higher time frame? If you are the type that like to stay on 4 hours, 1 hour, it won't help you to see the bigger picture of what price is trying to do or what the algorithm is trying to do to engineer liquidity, imbalance, inefficiency, all that and so on and so forth, in order to move price to where they are drawn to or where it's drawn to. So now I used to tell those on my private mentorship class, learning synthetic indices using ICT algorithmic concept, I tell them to use the monthly, weekly and the daily to determine the direction of where large funds are going to. So now this is the monthly time frame. So let's zoom in. So now if we look at this monthly time frame, what do you see? Can you see that the month is showing weakness we are experiencing weakness in the time frames. So we are experiencing the market to be going lower. So the market has already this chart, this monthly chart has already shown us that we are already going lower on our monthly time frames. So we are bearish on our monthly time frame, so we expect price to continue moving lower. So how do we know that? Look, we have a high, this series of highs, and we have another high, we have another series of equal or relative equal highs, and they have not been taken. This high failed to take that high, this high failed to take that high. You don't even need a trend line to show you this. This has already delineated out we are bearish. Although we have some choppy movements, this is an area of consolidations in the marketplace for V50 on the monthly time frame. So now, after we've established that, what do we need to establish? We need to look for premium and discount price array. From this swing high down to the swing low, where is premium markets and where is discount market? As usual, whenever you are doing this, your premium market will always be seen on top of your range from your swing high to your swing low. If you are doing it from the reverse of a bullish market, from your swing low to your swing high, all premiums will be at the top, all discount markets will be down. Then the midpoint is your equilibrium, the 50% of the range from the swing high to the swing low for bearish market, or from the swing low to the swing high for bullish market. The midpoint of that, when you use your fibs, that is where you are going to be looking for your equilibrium. So now let's establish that. So this is what I look for in price. Equilibrium, this is the equilibrium, look at that. So what do? You make sure that you mark the equilibrium price. Most of the time I used to advise people to journal those prices so you won't make your chart messy. Mind you, this is also applicable to any pair. What I'm showing you is universal. If you can use it on currencies, you can use it on crypto, you can use it on any market. So once we've established this, we don't need these fibs again. So what thing essentially I want you guys to be knowing is that, all right, let me just do it this way. Okay, also done. I'll delineate the 50% and the equilibrium for you guys to understand what I'm looking at. So these are I used to look for my premium and discount price. So this will be your equilibrium, and this will be your premium. Premium is always at the top, like what I just said earlier. So your discount at the bottom, your premium slash the premium arrays, and the discount market slash the arrays, they will always be found here. So now when you plot your fibs, the 50%, when we want to sell, we need to see price. Once price gets here, we want to see price going above the 50%, maybe into a retracement of 75, 79, 70%, 62%, and so on and so forth. But it must come above this 50% for us to see a reaction before we can know what price really wants to do. So if you also pull it from here to there and the market retrace, you will be getting this. You'll be getting 62, 70 something percent here. But that's not what we are looking for. That's not what we use only. Whenever we are using our fibs, like from this, I'm using this swing high to this swing low. I want to know what is going on in this price. I want to understand why price is consolidating here. So that's what I want to be showing. So with that case, you guys were like finding it difficult to mark the order block. Someone used this candle in our chat, in our private discussion. Not our private. It looks like the private, but that we do more than that in our private discussion group. But someone someone marked this as his own bearish order block, and I was like correcting the person that this initially, yes, it's an order block, but we don't use this. This is just like a nested PD array. This is an order block that is forming inside an order block. The order block is the last down close candle. Yes, I agree, this is the last off close candle for the bearish order block. So the bearish order block, this will not be the actual bearish order block. You can use this, but it won't make sense when you are not using the actual one. So this candle, this last two candle, 1, 2, was what? The bearish order block. It was traded through, and it also did what? It took a low. It took a bullish order block, broke that low, or this, you can use this low, but in between, this is the intermediate term low that was created. So it take this short term low down like that, boom, to the downside. So it validates this area to become a bearish order block. So how do we delineate it? We are marking from this candle to that highest week. So if we are to add, if for those that cannot see, this is not a strategy, mind you, please, this is not a strategy, please. I will say it again. Many people think this is a strategy. It's not a strategy. It was never intended to be a strategy. Out of the understanding of what we are doing here is where you frame your strategy. I know everybody, new traders, they are highly impulsive. They want to always click the button for, to make money. And I'm not saying it's not a good thing. We are all here in this business to make money, but sometimes we don't understand the rules that is backed up by this algorithm that move pricing, that move and engineer price in all universal trading asset class, including synthetics, forex, currency. This I'm explaining is the same way you also do it on the currency, on the future index, whatever. As far as there's a chart, as far as not only chart, mind you, as far as the candlesticks respect OHLC. What's OHLC? Like, I put my cursor here now. For instance, let's assume, okay, OHLC means opening price, high price, low price, and closing price. All candles have their opening price, their high price, their low price, and their closing price. Anything that doesn't ask that is not a candlestick. Please get away from that kind of market, if it is even called one. Without that, the market cannot exist. So let's continue. So now, this last up close candle, this is what you delineate from this week high, highest week, to the low. So what did I teach you about the other block? So we are using this as the other block. You can't use this. Why? Because you might say, why did I not use this? It's not the last up close candle before the move down. If this market, these three candles, was able to break the low here, this significant low down with an aggressive move, we classify this also as a bearish order block. Now the last up close candle was here, which failed to take this high. And all this candle you see, many people will say, why did I not use this candle? I'm using this big candle because it engulfs this candle. Do you see how it engulfs it? The body engulfs all this candle. So we are going to use this and this as our bearish order block. So it's not a pattern look type of a thing. We are not looking for patterns, we are looking for narratives. So this is how you identify it. For those that can't see, I don't do this box marking. I'm just trying to show you what I am seeing. So now we know that from this range to that range is what is our discount, is our swing. From the swing high to your swing low is your range, that you want to work with. So that range, we found out that we have a premium market / arrays, and this we have a discount market slash arrays. The arrays there means your arrays, this is what we essentially call PD array. The PD array means premium discount arrays or range or market or algorithmic signatures, whatever. Your arrays are like your order blocks, breaker blocks, mitigation blocks, fair value gaps, and all of these. Now, one thing I want you guys to take note of is that whenever you are trying to use this concept, the ICT concept, you need to be looking more at your left hand side. It's a look back range. So that is why I said it's not a strategy. You have to consider what's going on your left or what has happened on your left hand side, because most time people tend to look at their right hand side and they get too fixated on only what's going on with the current market price. They will not see what has happened in the past. So essentially, which I would like to explain what price action is. Price action generally is very simple. If you are asked what's price action, just write this in your note that price action is the act of using past price performance. That's at your left. Your past price performance in correlation with your current price performance. These are your current price. On the monthly time frame, these are the current price. If you are looking at all this range, they are your current price. But when you are looking at what has happened in the past, they are your past price. Using your past price performance in correlation with your current price performance to anticipate future price direction. So essentially, we are predicting future price. We are not retail traders. We are not thinking retail and we are just focused on all this present price, what's going on, this and that. We are trying to anticipate where is the algorithm trying to move. It's trying to move price to, based on the next draw on liquidity and based on other factors that are aligning with that too. I want to save time. I don't want this lesson to be very long. So now, this is your order block. And what did I tell you about the order blocks? So I say your order blocks. Now you know that this last up close candles, this series of 2 up close candle that was traded through. Now, beautiful. Look at what we now even have here again. Let me take this off. Now, these 2 candles that was traded through down created a fair value gap. I hope you guys are seeing that fair value gap. Now, I told you that high probability order blocks will have fair value gaps in them. That was the fair value gap. Now, that's it. That was your fair value gap. This is the fair value gap that was created. This candle, this 3 candle, 1, 2, 3, 1. Look at what I just did just now. Now, this is what I'm talking about. When you are light candles, it will show you your open, high, low, and closing price. So that's what I was talking about, OHLC, for those that don't know what it means. So now let's continue. These are our candles. This is the fair value gap that was created. If you have not understand what fair value gap is, I think you can watch our the YouTube channel I did on fair value gap, so you'll be able to understand it. And also the class lesson video I made on how to find high probability order blocks. Now, these order blocks, this last 2 candle was violated, the low was violated, this lows was traded through, but we are looking essentially at this low of this candle. This low is what we are looking. So the order block was traded through this low, and that low validates it, creates a bearish order block, and we have a fair value gap. Markets the algorithm moved the price down, created a low, then it engineered again itself liquidity to come back to close this array. So now this is equilibrium. We are already in a discount array, so there's a fair value gap right on the this discount market. Anything under the equilibrium of this swing high to this swing low is called, they are all discount. Whatever you see, bearish, bullish, order blocks, breaker blocks, mitigation blocks, rejection block, will all be in discount form. They will be in discount form. they'll be in discount form. So all these equilibrium, on everything under the equilibrium will be referred to as discount. So you'll be seeing price wanting to go up, but anything above the equilibrium will be regarded as premium. You'll be seeing price wanting to go down. So essentially weakness will be forming here and strength will be forming down here. So this might act, the strength energies may act as true support, while the weakness energies that are produced by the algorithm to push price down will act as true resistance. So now let's continue. This a bearish order block. It was violated, it was created and validated. Now the algorithm went to balance this. Notice that the algorithm stopped where? At the equilibrium of this range. So it stopped at the equilibrium of that range, and after stopping there, we begin to see this choppy market. Why? Because it's respecting the order block. The levels of the order block have not yet delineated. I will delineate it now so you guys can see. So you see how the level was being respected, and I told you that the levels of the order block we start from the low, the opening price, the body to body of this series of this candle. You find the 50%. Okay, let's try and do it. Let's try and do that. So let's look for the 50%, the body to body. You take your fibs, you plot it on the body. The body will always tell you the stories, the wicks does the damage. So that's it. So this is the equilibrium. Let me delete that. So essentially this will be the equilibrium. We know that this is the low price, so we are focusing on price, the order block to be tested either on the low, the opening price, the low, or the equilibrium. So this is the low, this opening price, and the low here. It's not too much, but we are using all these last of course can. But let's take this away and we will note that. So this is the equilibrium of this order block. Now take note, watch our price begin to respect these levels. You need to put these levels on your chart. You might put this level also, but I just want you guys to know that 50% of a range or the main threshold, which is also the 50% of an order block, are highly respected whenever price gravitate to them. Once they are traded above it, you begin to see the market wanting to come down. If we've established that we are bearish on the order flow of a higher time frame, always start with the order flow. So now let's continue for again. I'm showing this because of the people that was marking this as the order block. This is not the actual order block. I'm not saying it's not an order block, but you didn't take note of this old candle, last up close candle, looking at your left and the bearish order block and what I said. In a bearish movement, when we want to anticipate a high probability fair value gap in a bearish order flow or in a bearish underlying market, we need to be seeing liquidity resting below. You understand? Liquidity resting below validates this order block to be high in probability. While for a bullish, we need to be seeing liquidities resting above the liquidity resting above will be sell side. So we need to see the algorithm take the sell side, tap into the order block that was created by the bullish candle, and we should see price rally higher. But for the bearish, we should see liquidity resting below as buy side, and the algorithm taking the liquidity into the closure of that fair value gap. We should continue and testing the levels which are all these levels, and pushing price lower. But the levels were being tested, we are seeing weakness. It's showing weakness. Why? Because there's orders. There's an order block here, and we even have nested order blocks in it. So it's very, here is a very powerful level, key level. Now your indicators will not show you this. Support and resistance will not tell you this. Nothing out there will tell you this. This is purely algorithmic. Now let me even show you something beautiful. Look at your left hand side. Look at this. Just like I said here, this candle engulf all these candles. Now if we take this also will be our bearish order block. Why? After this down close candle, the last up close candles was, that is where the last up close candle closed. Regardless of these candles that was moving in and through inside of this one big monthly order block, we have series of consolidations. When you see candle doing this kind of movement like this, choppy movement, is consolidation, is consolidating. Now look at what happened. The low of this order block was broken here with these two candles. What do we have again? We have fair value gap, the same fair value gap, the same fair value gap I was talking about, like this one. We have another fair value gap here. So this fair value gap, let me just show it to you guys. We have a fair value gap here. To that. So we have a fair value gap that was created. So this is the order block. This last up close candle, please take note of this. The levels that are you'll be wanting to seek entries, the low, opening price, and the mean threshold of the body to body. That's what we are using. So now look at this fair value gap. It makes it high in probability. And what do we have again in that fair value gap? Though we didn't have liquidities, the market went up, filled it, but did not completely fill it, came down, and the algorithm still wanted to fill it, and the algorithm went up and filled it. But let's take a look at this. Now you guys know this is a fair value gap as well as this. So let's take this and this off so that you guys will know, we don't see this thing too messy. So now we want to find, we know this is the low, the candle low opening, the mean threshold is what we are looking for. So we use our fibs to do that. So our fibs from body to body. Now from body to body, yeah, yes, then we adjust that. So look at the 50%. This is the equilibrium of the main threshold of that order block. So the main threshold was that. Let's take that. Now notice the mean threshold. I told you the mean threshold are very powerful when you are trying to see. The best order block will not trade above their mean threshold, just like how this order block here did not trade above its mean threshold. Hold on. Alright, now this is the mean threshold of the order block. Do you see something I'm seeing clearly? Look, watch closely. See how after closing the fair value gap, look how price maintained and respect the mean threshold. When you see price action do this, that the body stayed inside of the mean threshold, that is purely algorithmic. This is an algorithmic, very powerful, very powerful. You see, I'm just stressing the word powerful. This is a very clear sign that this market is being respected. This is algorithmic. And what happened? The price went lower, it respected it, and everything started dropping lower to move price lower. So this order block is very powerful. So now for those that are saying that the algorithm will do this, will do that, later it take for aim for the buy side, I don't think so. It's unlikely for it to come here. That's why we are seeing consolidations. If it respects the mean threshold of this bearish order block and also the mean threshold of this bearish order block, why do we expect price to just go up like that? It's not that it would go up, but there is no narrative. I'm expecting price to move lower, and take this low here. So I'm expecting it to go lower and take that low, because we have a low resistant liquidities here. All here are high resistant. High resistant liquidities are liquidity runs environment are areas where we have all this choppy movement and price is not showing willingness to break through. So this is not choppy, and yeah, so it's easily, the algorithm will easily take out this low, or when I say take out the low, it will weak it or just break it, something like that, like this. So this one is why it respected here. It respected the mean threshold because here was algorithmic in price action. So it was algorithmic in price action. Yeah, that's what I was trying to say. So that's why this area was taken. So we have more low resistant liquidity run environment here, so I expect the algorithm to move price lower. So let's just drop into the weekly time frame and see some of this thing playing this PDRs. Now look at this. Now look at, apart from it respected this bearish order block 50% and the equilibrium of the range. So look at what's going on here. We have a rejection block here, the highest week. The market came, take out this buy side liquidities, did not take the high, so it's an rejection block. The body had already tell the story here, so the wick just did the damage. So within that we have a bearish order block that was forming from this last of close candle in the weekly. Do you see how we are breaking it down? So when you look at this, what I taught you, a high, a low, a higher high, and a lower low. Now this higher high tapped into where the 50%. That is what made it come down. Apart from the wicks and all that, many people will use this wick. They will say this is a high, they will say this is a high, a low, and a higher high. You're right, but we have to consider the bodies also. So now that's why I said the bodies tells the story, the wicks does damage. So there are also there's more to that. There's more to that also, as I just said. So we have a high, a low, a higher high here, and price sell off down here after the wicks does the damage. You don't believe me? Then look at this. What do you see? A high, a low, a higher high. Why am I not using this? This high to this. This is where large orders are found. The wicks are just doing the damage. That's where everybody that's where everybody are messed up. Everybody gets messed up, including I myself, anyone. You can't predict that kind of move. The wicks are not predictable to some measurable degree, but you can. We know how to predict. We can predict that too, but I'm not going to be talking about that in here. So this is the body. We want to be catching the bulk of the volatility on the body. We are not catching the wicks. The wicks are just manipulations, although they are price data. When you go to lower time frame, the wicks are very more essentially useful, or tend to be useful on the lower time frame, but you just have to see it like this is the matrix. So this is the high, the low. What do we get? A bearish order block. We have a fair value gap here. The market will trade into it. And what do we have here? Another. What do we have here? I will not say, most people will say this too should be a breaker block, but I would not take this as a breaker block. This is not a breaker. The breaker has happened here, so this is a mitigation. We have a high, a low, lower high or a higher lower, whatever. This high failed to take that high, then market break through that low. So the wall breaker is this candle. Let me show it to you. This candle. So the 50% of this candle, the opening price, the 50, this big candle, the last of course candle, which you will treat as your order block. We should see price respecting that level. The opening price, the main threshold of that order block, then price should essentially sell off. So I hope this was insightful to you guys, and I hope you guys learn one or two things, but try to always stay with your chart, practice what I've shown to you. And if you have any question that will be asked, you can drop most of your questions in the comment below. I'll be leaving for those that have not joined our Telegram discussion group, where we talk about price and we talk about all these algorithmic principles and tools you can use also in synthetic. So do you see how price was respected? Look at here, you can see a very good respect of their algorithm in price action here. So this is also a mitigation, a high, a low, a high, a failure swing that failed to take this, and what happened, price sell off. So you zoom to your lower time frame, and once you are in this level, you see you treat this as an order block. If this was treated as an order block, the 50% was respected, even though it wicked it. They didn't close with the body candle, so it was respected. And what happened? This level was the monthly bearish main threshold, the order block of the bearish monthly, or the monthly order bearish order block of the this was the main threshold of the bearish monthly order block, I mean to say. So it was respected. If you plot your fee from the swing from body to body, draw the main threshold, outlined it in time, you should see price show weakness. Wicks shows the weakness and also does damage. The body shows the strength or the energy. Let me not use the strength. The wicks are showing exhaustion, the body are showing energy. Let me just put it in that way. So it's science, it's a science, an exact science. And you see this keep happening. Look at breaker here. We have a high, we have a high here, a low here, a higher high, price break off. We have a very short we have a fair value gap, extend that fair value gap, expect price to go in, and what happened? Price sell off down. You didn't believe me? That's it. It's your breaker. A high, a low, a high, a low, a higher high. Yes, market went down, take the low. Why is it going down? It tapped into the 50% of that range, respecting also that level. It didn't even get to the main threshold of the bearish order block over here. And here what happened? This is what happened. Price fell off. If you're in an intraday lower time frame, you would know why you should take straight setup. If you miss the setup here, you can come back, take it over here. Let me return it back to the chart. You can, if you miss setups here, you can take your setup here, around here. The price eventually gave up the ghost and fell off into a bullish order block over here. So the price rally off. You can't see it, but the last series of close candle, we've been taking this series of down close candle down to this candle. I will use this candle because all this was engulfed in that candle. You can use this candle as the bullish order block, tapped into it. This candle, I'm talking of this one, tapped into it. So this is series of down candle, close candle. We can't use this, but we can use this because all this candle engulfed in this is the last down close candle, and we use that, extended the time. It respected it, went up higher. Also tapped here, rejection, understand, and you can see price selling off and doing all his thing. And this is where the choppy movement started from. So I hope this was insightful to you all guys. And if you have any question, just join our Telegram discussion group and post in your question in the comment link below. So with that being said, I'll catch you guys later in our next class. Until then, take care.